The countdown is on for the Federal Reserve's next big decision on rates, and while nearly 80% of those in the know are pretty confident we'll get another rate cut tomorrow, there are plenty of opinions floating around about what happens after that. CNBC senior economics reporter Steve Liesman's got the details.
Markets are pretty clear on what the Fed does this week, but the outlook gets murkier beyond that. 79% of respondents to the CNBC Fed survey look for a 25 basis point rate cut to be announced by the Fed. That would bring the funds rate down to a new level of 1.5 to 1.75%. But on average, the survey shows another rate cut is not expected until February 2020. Only 37% forecast a rate cut in December, so the majority banking on a pause. By the end of 2020, the funds rate goes down to just 1.4%, which is to say the market is not fully convinced of any more cuts after tomorrow. John Donaldson, director of fixed income at Haverford Trust Company, writes in response to the survey, quote, after the next cut, the Fed funds rate would re-enter the zone where there is no evidence that further cuts help the economy. If ultra-low rates and negative rates are such a panacea, why aren't Japan and Germany growing at 6% rather than teetering on recessions? While they're uncertain of future cuts, respondents are increasingly concerned over the effects of the trade war and global economic weakness on the U.S. economy. The chance of recession in the next 12 months stands at 34%. That's the highest level since 2011. But the base case of respondents, the U.S. continues to grow, just more slowly. 2.9% GDP growth in 2018 is seen giving way to 2% growth this year and just 1.75% next. Joel Naroff, president of Naroff Economic Advisors, writes, the most critical issue facing the economy is the trade war, and interest rate cuts will do little to change the course of growth as long as the threats of tariffs persist. 76% of respondents say tariffs have resulted in higher prices for consumers, and 60% have cut their growth forecast for this year and next due to the tariffs. 46% say tariffs have lowered consumer spending. So the murky outlook for the Fed and the economy seem to flow directly from the uncertain outlook for tariffs and their impacts on the global and U.S. economies. Back to you.
All right, Steve, thank you. Steve Liesman back at headquarters. As investors try to guess the Fed's next move, our next guest says the central bank is playing with fire by remaining passive in a world of rapidly falling rates. Let's bring in Jim Bianco, president of Bianco Research Firm from Chicago. Jim, great to see you again.
Thanks, Bill.
What do you mean by passive? What should the Fed be doing?
Well, we live in a global world, and we live with global interest rates as well, too. Right now, for the first time ever, the funds rate is the highest in the developed world, the highest policy rate in the developed world. We also have the highest 30-year bond rate, the only one over 2% in the developed world. I think people first have to recognize we have high rates in the U.S., and that you have to get used to this idea that 0 and 1 is kind of the regular rate. Second of all, if Europe is at 0 or negative, there's a bunch of big multinational companies that can borrow at 0 in Europe to fund their operations. U.S. companies, U.S.-only companies don't have that luxury. So they're put at a competitive disadvantage. So yes, if Europe lowers their rates, it forces us down. Now, they could get on the phone and call the ECB and call the Bank of Japan and say, you got to raise your rates. You've got them at the wrong level. But if they're going to drag them down to negative, they're going to force us lower, too. And if the Fed wants to stick their head in the sand and say, I don't care where the rest of the world is, this is where we should be, I think they're going to make a mistake because they're going to put U.S.-only companies that can't borrow at 0 in other countries at a disadvantage.
So you think the Fed should go to 0?
I don't think the Fed should go. Actually, I think that Europe and Japan should raise rates. Is what they should do.
I mean, I don't think we have much control over that. So,
right, but I think we should be
calling them and telling them what to do. What should we do?
We should go more closer to 1%, maybe even under 1%, because we have to stay in that range. Again, this is the world we live in. If they're going to go down there, we cannot ignore it, and we have to kind of follow suit as well, too.
So, Jim, you're speaking in terms of what it means for U.S. corporations, multinationals. I get it. But is this bigger than just that? I mean, is this a rabbit hole that the world seems to be going down that there is no escape from? And the collateral damage will be far bigger than just Honeywell not making numbers one quarter?
Yeah, I mean, there's two ways to answer that question. Yes, there is a rabbit hole we're going down in the form of negative rates. That's a giant mistake. That should be undone. But then there's another, if you would, rabbit hole in that we live in a world of technology. We live in a world of aging populations that demand safe investments like fixed income securities. And that's why we keep pushing interest rates lower and lower. It's amazing that I hear American investors keep complaining about 2% yield Whereas I was like, you'd be lucky you're not a European investor. They have negative rates. Get used to this. This is the world we're in right now. That 0, 1, 2 is where interest rates should be, 2 being on the high end of the curve. Those that are pining for the 5 or 6 or 7% worlds, you're only going to get that if we have a mistake, and you're not going to like it because of the mistake that would cause us to have rates go that high again.
So, Jim, this is Brian Kelly, but what about the argument, the other side of it, saying the reason why Japan and Europe, and Japan in particular, has been mired in this kind of slow growth for years is because their savers are not getting anything on the money that they save. So you're here in the U.S., it's only 2%, but at least they're getting something on their savings, which puts a little bit more money into the economy, and that's the reason why the Fed shouldn't cut.
I think that argument is true, but it's got kind of the causality backwards. It is the aging population of Japan and the massive number of savers that are plowing in the fixed income investments that first push their rates down to very low levels, and then the central bank takes it over the finish line to negative. Look, the central banks can't take rates where they would normally be at 6%, say 10 years ago, and magically make them negative. You have to have a combination of no inflation, and you got to have demographics of old people looking for investments to get them down to 0 to 1 to begin with. Then the central bank could maybe kick in and push it to negative. So even without the central bank, their rates would still be very close to 0 anyway, given the massive investment need that they have of their aging population. They don't buy stocks. They buy fixed income when you get over the age of 65.
Just to connect this all, your analysis, Jim, to the stock market, domestic borrowers, meaning small caps, get hurt because they have to borrow at a higher rate. And then international, multinational companies get dinged by the stronger dollar. It sounds like no one benefits here.
Yeah, they don't. And you can see it I think you see it in the way the stock market trades. First, the debt to equity ratios in the Russell 2000 are actually now higher for the first time in decades than the S&P 500. And the Russell 2000 has been underperforming. Now, there's other reasons that's happening too, but one of the things is those companies are at a competitive disadvantage to the larger companies. IBM's got 15,000 employees in Europe. They can borrow at 0 to fund that. If you're a domestic computer maker, you can't borrow at 0 to fund anything. So you're put at a disadvantage relative to them.
Jim, great to have you. Thanks so much.
Thank you.
Jim Bianco, Bianco Research in Chicago.
It's hard to argue with what his point is, that the new normal is 0 to 1 to 2.
Yeah.
If you look at the 30-year Treasury over the the 10-year Treasury yield over the last 30 years, you just see a slope that goes like this. It bottomed out at 142 just this year, and we've seen at these peaks. We saw it in 2000. We saw 6.25 on the 10-year Treasury yield. In 2007, we saw 5.25. We just saw 3.25. What happens when we have those kind of touch of the downtrend? We see stock market palpitations. The first two I mentioned, 50%. Last fall, 20%. Who knows what the heck happens here? But we're back down below that trend, even at 1.8.
You know, he was talking about this 0, 1, or 2%. So where do you go? And he talked about internationally, they all go to fixed income. That's not what we see here. And that's part of the reason that we're getting such a bullish push, I think, in the stock market. Doesn't mean it's not dangerous, but that's where people are going because that's the only place they can go for any yield.